Hey folks, ever wondered how Warren Buffett became the greatest investor of all time? Today I'm here to spill the secrets that turned him into a master of investments. From long-term commitment to the art of avoiding omission errors, discover how he built his fortune. And trust me, it's not just about numbers, it's about principles we can apply in our lives. Stay tuned until the end because these tips can change the way you see the world of investments. Oh, and don't forget to subscribe to the channel for more valuable insights like this. Let's dive in. 7. Integrity, initiative, and intelligence. When Warren Buffett is building his team, he really looks for three things: integrity, initiative, and intelligence. He places a lot of emphasis on these qualities when hiring for his investment company. And you know what? It makes complete sense. After all, if someone lacks integrity, even if they're super smart and motivated, it won't work. Integrity is the foundation. It's what sustains everything else. He wants people who not only understand the numbers but are also ethical and trustworthy. Something interesting he points out is investors' behavior. Often people act quite human in the markets. They get excited when things are going well and, in hindsight, think they'll earn even more. But when things go south, panic sets in. And that's the opportunity. Buffett says these ups and downs create chances for those who can keep a cool head. It's like he's saying, don't be swayed by the rearview mirror. Keep your focus on what truly matters in the long run. Buffett's investment approach has evolved over time. He started by looking for cheap stocks like cigar butts, but now he prefers investing in wonderful companies at fair prices. He realized it's easier to make money by investing in something truly good than in something cheap, but perhaps not so impressive. And you know what? He insists it's crucial to invest only in what you understand. He calls it the circle of competence. If you don't understand, simply don't invest. It's that simple. And last but not least, he emphasizes the value of avoiding omission errors. The biggest mistakes he admits making were omissions, missing out on opportunities that were within his understanding and reach. 6. Understanding investment. Investing means spending money now to get more money back in the future. The key is understanding how much money you can get, when, and how certain it is. When I think about investing, I see it as spending money now to reap even greater rewards down the road. The trick is to understand exactly how much money we can get, when it will happen, and how certain we are about it. It's like a game of financial predictions, but with the guarantee that if we play it right, we'll see the return later on. Let's talk about stocks, for example. When we look at a company, what really matters isn't just its current value, but how much money it will deliver in the future. Warren Buffett always emphasizes this. He compares investing in stocks to buying a farm. If you buy a farm today, you want to know how much it will yield over the years. The same goes for stocks. It's all about calculating intrinsic value, understanding what that company will put in your pocket over time. And believe me, it's not as simple as looking at a stock certificate. Unlike bonds, where payments are well-defined, stocks require a bit more work. We need to turn that piece of paper into something that truly represents what the company will deliver in terms of cash flow. That's where the analyst's work comes in, shaping this piece to understand how much money we can expect. It's a meticulous analysis, but crucial for making sound investment decisions. When I think about a company's intrinsic value, I always think about buying not just a part of it, but the whole thing. That's how I approach investments. I look forward and ask myself, what will come out of this business and when? The beauty of all this is when the company not only makes money, but also uses it to achieve even better returns. That to me is the true intrinsic value. It's like we're making a bet on the future, but a bet grounded in solid fundamentals. 5. Avoiding herd behavior. Investors often make mistakes by following the crowd or reacting impulsively to market trends. Buffett highlights the importance of maintaining rationality and avoiding decisions based on the rearview mirror. When it comes to investing, one thing I've learned from Warren Buffett is the importance of not blindly following the crowd. It's easy to fall into the trap of acting like everyone else in the market, especially when things are going well or poorly. Buffett always stresses keeping a cool head. He says many investors make mistakes by impulsively following market trends, and I totally agree. Sometimes it's as if people are driving while only looking in the rearview mirror. What Buffett emphasizes is the need to maintain rationality. He advises not letting emotions like excitement or fear dictate investment decisions. It's like he's saying, look forward to what's coming instead of relying too much on what has already happened. And it makes sense, right? If we keep looking back, we'll miss the opportunities ahead. I find it fascinating how he compares investors to behaving like a herd. When everyone is going in the same direction, it's easy to feel safe following along. But according to Buffett, it's in those moments that great opportunities can arise for those who have the courage to stand out from the herd. It's like he's giving us a reminder not to be blind sheep, but rather conscious and independent investors. So the next time the market is tumultuous and everyone is running in one direction, I'll remember Buffett's advice. Stay calm, assess the situation rationally, and don't let herd behavior dictate my decisions. After all, in the world of investments, the courage to be different can make all the difference. 4. Investing in wonderful companies. I take Warren Buffett's advice seriously when it comes to investing in wonderful companies. He advocates for the idea that it's much more advantageous to put your money into solid, long-term businesses than to hunt for cheap opportunities that come and go. And it makes sense, right? Instead of jumping from one branch to another, I prefer to focus on companies that have a solid foundation and the potential to continue growing in the long term. The thing is, Buffett isn't after shortcuts or quick fixes. He wants to build something lasting, something that grows and thrives over time. So when he says to invest in wonderful companies, he's kind of giving us a hint to think about investment like a long-term relationship. It's as if we're choosing a dance partner for life, not just for one song. I admire this approach because it requires patience and vision. We're not talking about quick gains here, but about building wealth over the years. And you know what? These wonderful companies have something special. They're not just good now. They have the potential to remain amazing in the future. It's like investing in something you believe in, something that makes sense and has the potential to grow and evolve over time. So the next time someone suggests there's a cheap and quick opportunity out there, I'll remember Buffett and follow the path of wonderful companies. Because in the end, investing isn't a short-term race but a long-term journey, building something worthwhile over time. 3. Circle of competence. One of the most valuable lessons I've learned from Warren Buffett is about the circle of competence. He keeps emphasizing investing only in what we understand well, and it makes complete sense. I won't venture into something that's a mystery to me, and neither would Buffett. If the idea is to invest, we need to understand what we're doing, right? The circle of competence is like our safe playground. What we know deeply, where we know the rules of the game. It's like I'm comfortable, not losing sleep at night wondering what the heck is happening with my investments. Buffett always highlights that ignorance is the last thing we want when it comes to money. I don't know about you, but I prefer to play on the side of certainty. I find it interesting how he compares this to buying a farm. If you know the soil, understand the crops, and know what to expect, you're much more likely to succeed. The same goes for investments. If you can't explain to someone what a company does in simple terms, maybe it's better to move on to the next one. I want to invest in something I understand inside out, where I can predict what's coming. So the next time someone suggests investing in something that seems amazing, but you have no idea what it's about, remember Buffett and the circle of competence. Don't fall into the trap of the unknown. Trust me, it's much better to invest in something that excites you and that you truly comprehend. That's how we build wealth solidly and without unpleasant surprises. 2. Avoiding omission errors. Buffett highlights that the biggest mistakes he made were omission errors, missing out on opportunities that were within his understanding and reach. You know, when I think about the mistakes I've made throughout my investment journey, I find myself reflecting on something Warren Buffett calls omission errors. It sounds a bit abstract, right? But it's simply about letting opportunities that were right in front of me slip away, things I truly understood and could have seized. Buffett emphasizes that often these are the mistakes that hurt the most, and believe me, I completely understand. What he means is that instead of making mistakes by doing something wrong, often the biggest regret is not doing anything when the opportunity is knocking. And that hurts. He gives an interesting example, like if you see a company with incredible potential but decide to stay out, it can cost you dearly down the road. I found myself in that situation, and the feeling of missing out on a crystal-clear opportunity is frustrating. Buffett shares these stories not to lament but to alert us. He wants us to be vigilant, ready to act when a good opportunity arises. I've learned that if I understand something, if it's within my circle of competence, I need to be proactive. You can't wait for perfection because most of the time it doesn't come. The secret is to act when the opportunity is good enough, even if it's not perfect. So, the next time an opportunity arises and I'm in doubt, I'll remember Buffett's words about these omission errors. Because in the end, it's better to try and fail than to wonder, what if, later? The investment game is like that, full of lessons, and I'm here to learn from them and improve in the game. 1. Long-term commitment. One thing I really admire about Warren Buffett is how he views long-term investment. He's not into seeking quick gains and selling assets just because someone offered a high price. No. He adopts a more, let's say, marriage-like approach to investments. When something is good, he keeps it. He discourages selling assets just because they are high at the moment. It's more about looking at intrinsic value in the long run than short-term movements. His commitment is something that resonates with me. He's not interested in following market trends or succumbing to the temptation of momentary gains. The mindset is more like that of a chess player, thinking several moves ahead. He emphasizes that selling isn't the solution to everything, even when the offers are tempting. I like this approach because it's more about building something solid over time, like a well-constructed building rather than fleeting gains. I find it fascinating how he compares Berkshire Hathaway to a Buffalo News suite scoreboard. It's not just about selling for the sake of selling, but about keeping what is valuable. For him, selling is not an easy option. And you know what? He truly believes that the value of businesses we own increases over time, and I'm starting to agree more and more with this philosophy. So the next time someone suggests selling something just because it's high, I'll remember Buffett. Long-term commitment, focus on intrinsic value, and resistance to momentary temptations. That's how he built his fortune, and I'm ready to follow this more consistent and enduring path. And there you have it, folks. I hope you enjoyed these insights from Warren Buffett as much as I did. Now, before moving on to the next chapter of our learnings, I want to ask you something. Subscribe to the channel to not miss any of our discussions on investments and financial strategies. Give that like if you also think Buffett is an investment genius, and don't forget to leave your comment sharing which lesson surprised you the most. Let's build together a community of smart investors ready for financial success. I'm counting on you, folks. Until the next video.